Hi everybody, welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 155, we're going to dig into a little bit of basic planning that you can do if you come across an existing irrevocable trust that is a GST non-exempt trust. We'll talk about what that means in a minute and why this might be important. But for the time being, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of today's slides, please email me at griffin.bridgers@gmail.com. Now, I've given a number of GST tax presentations in the past and episodes on this channel, so it's worth it to go back and look at some of those. But just as a reminder, it's helpful to know these terms because these are really going to drive when the GST tax applies. One is that a skip person is somebody who, in the context of a trust, when it was created, was 2 or more generations younger than the grantor. Or if that trust has ever been included in somebody's gross estate, then that skip person is somebody who's 2 or more generations younger than that last person who was deemed to be the transferor of the assets by the application of an estate or a gift tax. And if you have somebody who's outside of the family tree who's not related, they could also be a skip person if they're an individual who's more than 37.5 years younger than that grantor or transferor, other than a spouse or a former spouse. And then a non-skip person is just anybody who's not a skip person. So why is that important? Because the generation skipping transfer tax generally only applies to any transfers that go to or for the benefit of a skip person. And that's going to be important in the trust context because if you have a GST non-exempt trust, then it's a trust that has a huge looming tax liability hanging out there. What's going to happen is somewhere down the road, there are beneficiaries right now who are non-skip persons, and when they die or when their interest in the trust terminates, there will be a huge tax at that time, 40%. That'll be what's known as a taxable termination with respect to the trust, and the trustee will have to pay out 40% of the value of the trust at that point, or up to 40%. And that could be intimidating to look at this type of trust and think, oh man, what do we do with this? Or how do we treat this? Or how do we administer this? But you don't necessarily need to be intimidated. There's some easy workarounds and low-hanging fruit that will allow you to at least defer, if not avoid, this pending GST tax that's inherent in this non-exempt trust. One, you should always analyze a non-exempt trust and look at whether or not any beneficiary, especially a non-skip beneficiary, has a general power of appointment. If so, that might take away some of that GST tax. That might solve the problem, at least partially, because what that means is that whoever that non-skip person is will end up applying their own GST exemption to that trust at death, which will take away some of that GST tax potentially. Now, it could well be the case that the value of the trust exceeds their remaining exemption, that non-skip person's exemption, so there could still be some GST tax liability, but this could also be a risk where that non-skip person has some estate tax liability as well, but all of those could be avoided with a formula. Now, we're not talking about drafting, so we're not worried about whether or not there is a formula. It's just a matter of looking at that big picture as how that general power of appointment could affect the trust as a whole. Now, regardless of what type of power of appointment the non-skip person might have, whether it's a general power or a limited power of appointment, you might still be able to reduce or defer some of the GST tax simply by exercising that power of appointment. Now, you could exercise it in one of these ways. One, you could name other non-skip persons as beneficiaries, which would defer the estate tax until their deaths. Now, they become beneficiaries in the process and might receive some distributions, but as we'll see on the next slide, that may not be as bad of an outcome as you think. Another thing you could do is look at giving other persons especially non-skip persons, a general power of appointment so they could use their own GST tax exemption. And that's something where even if the non-skip person who's your client doesn't have a general power of appointment, they can still exercise a limited power of appointment to create a new general power of appointment for another person. So there could be upstream planning to parents or whatever the case might be to use these unharvested GST tax exemptions that might be hanging out there from people who aren't beneficiaries but are within the family. Another thing you could look at is if you have a situation where, like we saw in the last slide, you have a non-skip person holding a general power of appointment, and that's going to cause some estate tax for them, what you could look at is exercising that power of appointment in favor of a charity or a spouse, which will avoid or at least defer some of that generation skipping transfer tax as well. Beyond that, what you could do is look at now draining the trust. Does it make sense to make distributions to non-skip persons who are either current beneficiaries with respect to the one non-skip person we're worried about, or even potential beneficiaries that might get added by the exercise of a power of appointment? Now that drains the trust, and this really helps in a situation where those same beneficiaries might also be beneficiaries of a GST exempt trust, because the non-skip person's needs could be maximized from this non-exempt trust, and then skip person's needs could be maximized from the exempt trust. So by draining the trust and reducing the assets in it, you're going to reduce the amount that's subject to GST tax in the future, especially because distributions to non-skip persons won't incur GST tax. Now the catch-22 here is that you're introducing assets to the taxable estate of those non-skip persons. So it may help to have many beneficiaries, and it may help if they don't have many assets to begin with, so you don't cause an unnecessary estate tax problem for them. Next, you could look at maximizing health and education distributions. So usually, if you have a GST non-exempt trust, distributions to skip persons will be subject to the GST tax. However, there is an exception that says that direct payments of health expenses and tuition on behalf of those skip persons are not subject to GST tax. So those types of distributions can be maximized in a way that drains the trust. Most of the time you're going to have a health, education, maintenance, and support standard for distributions. So if you can carve off health and education and allocate those to this non-exempt trust, that's a great way to avoid GST tax now or in the future. And finally, one thing you look at too is that life insurance is often thought of as a liquidity tool for potential estate tax liability, but it could also be a liquidity tool for potential GST tax liability. So depending on the age of the non-skip beneficiary or beneficiaries, it might make economic sense to have the trust purchase life insurance on that non-skip beneficiary's life that would pay out at the taxable termination, which was the GST tax event we're worried about. So even though we're not avoiding the GST tax here, we're creating tax-free liquidity that could pay the GST tax. Now, there's some catches here. For one, that the non-skip beneficiary can't have a power of appointment over that life insurance if we want this to work, but that could be a great tool for trusts that hold illiquid assets like farmland or investment real estate or even a family business to create a source of cash to pay that pending GST tax and not drain the rest of the trust assets. Now, the big picture is that all of this is important because the GST tax is not going away. The GST tax exemption is pegged to the estate tax exclusion, which is currently $11.7 million. So if that exclusion amount is reduced, that's also going to reduce the GST tax exemption and potentially drive up the potential for tax with these GST non-exempt trusts, whether they currently exist or are created in the future. And for ones created in the future, there's a bigger chance that they will be GST non-exempt. It's also important to note that portability elections do not preserve a deceased spouse's unused GST tax exemption. So for all the portability-based estate plans out there, there's little maximization of the GST tax exemption in the planning process. So there's going to continue to be more and more GST non-exempt trusts hanging out there. And knowing what they do, how they work, how they operate, and how you avoid or defer GST tax on those will become more and more of a vital element of any estate planner's toolkit. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.